Hi, everyone. Here's Ben Black with from Akkadian Ventures and the Raise Conference. And welcome to Tipping Point. And I'm here today with Ryan McDermott from Resolute Partner Group. Ryan and I are go way back. Ryan, you want to introduce yourself and the firm a little bit?
Yeah, sure. We started as an RIA in 2019. We were really big backers of a lot of the Unity founders. And so we intrinsically work with a lot of those people, but we're kind of video gamers at heart, right? And so when we thought about the firm, we wanted to make sure that we were clear in being resolute on our ethics, but at the same time, we thought there would be a fun kind of wordplay and that role-playing games are our general favorite genre of video games. So we thought that we could do RPG, and that's what we've done. And we've really kind of stuck with people who are developers, creators in the video game industry at the same time as people who create engines and software packages for the industry.
What sort of differentiates your group from everyone else and how you approach the business?
I mean, for us, it's an incredibly intensive relationship that we have with our clients. And so it's more of like, we looked at it day one as a long-term partnership, that our clients weren't necessarily within the finance paradigm. We felt that like most financial advisory services were pretty much paternalistic to their client base. And we thought that that was just unsuited. Our clients are incredibly smart people, smarter than we are in most scenarios. And so maybe we could kind of put some finance guardrails around their intelligence, and that kind of let them do what they do, but we put up the guardrails and then we'd get a better result. And so I think that so far that's worked out perfectly. It's a true collaboration on ideas. It's a collaboration on what is a new thesis for investment. And it's, clearly we've removed the paternalistic idea of the advisor knows better than the client.
So today, we're here to talk about how you as a limited partner think about investing in venture capital as an asset class. And, when I was thinking about who to interview for this program, I thought of you immediately because one thing you told me on our last call was you have 45 investments in different venture capital funds, which is as big as any firm I know. I would love to hear about how did you think about building this program? Did you inherit it? What was the inception of your sort of investment in venture capital?
Well, I feel like I have to give credit to a colleague that I work with intimately, a guy named Benjamin Ratz, who runs an organization out of Sweden called Nordic Makers. And so first and foremost, Benjamin and I collaborate on almost every single VC deal that we do, so that he does or that I do. So there's a lot of cross-pollination. And from my standpoint, I had been working in the private wealth management business for a long period of time. And all of the firms where I was seated, there really was not an emphasis on venture capital. And there's the strong mandate that if you were not in Sequoia, then the asset class as a general was just a meaningless asset class. I think the data have shown that is not applicable, certainly in the last 10 years. And in fact, if we just look at post 2009, being exposed to growth was being way better off than being exposed to value. So the tables have turned, and obviously we have a hiccup today in the markets and so forth. I assume that these are blips, so fingers crossed, right? But the issue that I kept seeing is that some of the more, if you live in San Francisco, the ecosystem that you see is one of really startups, and it's of innovation, and it's of capturing the new idea. And this full emphasis on disruption is really attractive. And the best way to actually learn more about it is to meet the fund people, the VC fund people, to meet the various managers, to meet the entrepreneurs, and really immerse yourself in the ecosystem. And so that was probably the mandate that when I started RPG, I said, hey, wow, we have significant client money that wants to invest in disruption. It wants to do new things. It wants to be out there. Again, all of the clients, they're disruptors in their own right. They see the value of it. And so when you start with that premise, you can kind of dive into, let's call it, I realize Silicon Valley is now bigger than Silicon Valley, but you can dive into this ecosystem if you have capital, then you can start making the allocations that you want. And I think what Benjamin and I were able to effectively do was we were really able to hone in immediately on $10 million that we could allocate. And so if we start taking baby steps within that allocation, we can expand it out, which we've done. And so in late 2019 through the end of 2020, we signed on a bunch of managers. That's simple one vintage, right? So we all believe in, and that once you establish kind of a vintage amount, let's call that $10 million, that you need to maintain that vintage amount, right? So it's almost every year that you want to keep allocating that. As you know, it's like in the darkest of times, if you're not there, then you're not going to get the best investments, right? So it's like, it's all seductive to get in when, the NASDAQ set its all-time highest. If it goes down 10%, if you're running away, this is the wrong reaction. So this is like, you constantly have to be allocating. And I had done a lot of manager selection prior to, but most of it was candidly in the hedge fund space, right? So I kind of took this, and Benjamin was great because he had done a lot of VC deals. And so we kind of took his VC predilection. We took my kind of hedge fund allocator mind, or, long only equity manager mind, and we melded them together. And the questions that you ask the managers were sort of similar, right?
So what are the questions?
When you're meeting hedge fund people, right? You ask all these questions around risk control. You ask all these questions around sizing, how many days to get out of a position? How are the operational controls? How are the decisions made? Who's the prime broker? Who's clearing the trades? Who does the audit, right? Like, who can actually sign the checks when the money goes out? I would say, generally speaking, the VC world, there are controls, but they're just nowhere to the same extent thought out, right? And it's partially because, if you're going to go to a pension fund that is going to put in $100 million in your hedge fund, they're going to ask you different questions than the guy who's going to put in a $500,000 commitment into your VC fund. So a lot of the emerging managers aren't like quite ready for those questions, and that makes sense. But it was a learning process for me to understand, like, oh well, these people haven't had to endure those sort of questions. The typical hedge fund meeting, that cycle takes like 3 months, and you're asking about all their long positions, you're asking about their short positions. So you're really trying to get a flavor. And I would say that flavoring of the opportunity set is really drawn us to the venture capital world, right? And I remember early on in kind of contemplating venture capital, there's this question like, do you choose the generalist, right? Sequoia is pretty much a generalist fund and has incredible returns, or do you choose the very niche provider? And in the end, we generally defaulted to the niche providers because we could see certain themes that we explicitly wanted to express in our portfolio.
What would be the example of some of those themes?
One of the themes that we see, and you could apply this to drug discovery alone, right, is that if you're going to run trials or you're going to understand interactions of chemicals, the computing power that you can now put behind those ideas is just infinitely where it was, right? So just look at the speed with which warp speed came together with vaccines, unheralded, right? And so that cycle will only get quicker, right? So I'm hopeful for variants that, that's maybe not a 6-month vaccine cycle, maybe a variant's a 3-month vaccine. And eventually you'll have predictive, right? So that's a big theme. And then there's just, one of the like smart money-making ideas, like we invested in this fund with the guy literally, and I just love this from a cash flow, right? Because synthetic biology, you're not looking for immediate cash flow. So that's one thing, we understand that. But in other strategies, there's this concept of non-correlated cash flow. And so we were lucky enough to invest with a team, and all they do is they invest in little subscription businesses, right? And so the concept of subscription today versus 10 years ago is just night and day. And there are so many little niche markets that you and I don't even think about, but there's a subscription that has like catered to that market, and it's chugging along at $15 a month, and it's an amazing little business.
So are you typically have an idea or a theme and going to find managers, or are you just looking at what's coming to you and saying that fits our model?
Yeah, I would say about 80 of it's like top-down macro expression.
Okay.
Maybe macro, not by like global macroeconomics, but like, wow, we're really interested in like who's going to solve this weird idea, like who's looking at solutions in this.
Right.
And so that's kind of where we get all of the synthetic biology. That's where we honestly get a lot of ESG ideas, because there's a desire, because carbon sequestration, all of that's kind of down, top down, AI. And then I would say kind of the stuff that bubbles up is a little bit more like that subscription fund where you're like, wow, that actually is a brilliant idea and interesting, because you might get earlier cash flows on something.
I'm interested in your perspective, like allocating to hedge funds versus allocating to venture capitalists. Like, how different is it? And like, what surprised you the most, or you found most strange or odd about the way venture capitalists pitch you versus the way that hedge funds pitch you?
So venture is so this is great, right? So when we meet a fund, it's almost always going to be me and Benjamin on the call, right? And so Benjamin is wildly optimistic and I'm wild negative, right? And so when you have that standpoint, 2020 public markets worked really well. We have a hunch that private markets did well too, but we don't have the we don't have the money in the bank like we do on the public side. And there's a certain amount of seduction to that, right? And it's been a lot easier, again, since 2009, just to go out and buy, S&P 500 or triple Qs. And because of that, there's like some satisfaction of, hey, that could be all that we need to do. I don't believe that. I think that there's long-term, obviously correlations across all asset classes have been very high the last 6 months, but I think long-term you're going to see outsized gains in the venture side, right? So the illiquidity premium is going to start kicking in. I assume that all of those relatively easy returns that you got in just a long only QQQ type portfolio, my assumption is that those kind of mean revert, right? Like they should mean revert. And so but I'm not saying I'm at all unhappy about the venture capital, you just don't see it. But I think that it's been harder to allocate towards venture capital in a world where you see your publics just flying through the roof.
Right.
Let's say US long-term public is probably like a 6 to 7% idea, right? So if they did 21%, let's just say last year, well, you just captured like almost 3 years of a growth, right? I'm giving room for compounding. That's why I say just below 3 years. So that's kind of my mantra, right? And we've seen a hugely interesting private market. The amount of secondaries, as you probably see, just through the roof. Everybody's got an SPV vehicle. That's interesting. And then everybody's got a SPAC. And those are the side things. But venture is not that. It's just kind of like you're planting seeds and you're working hard, and those are the companies that will be SPAC'd in 7 years, or whatever the environment is, right? Like I assume there'll be some pullback on SPACs, but it's an opportunity that works for now. And it's a lot of the kind of mini VC investments I made a long time ago, a couple of them got SPAC'd out. So I'm actually really stoked on that.
You're in the management business as well, and you have managers that are reporting to you. And how do you differentiate? Like help us understand like what is a venture capitalist they really need to focus on to make you a happy long-term investor with them? Like what can they do better? How can they service you better so that during the long cold winters that are certainly going to come, because this business is up and down, you're there, you have a good relationship with them. Like how can they manage you?
Okay, so there's this guy Nathan Benaif. He runs Nathan Benaif. He runs Air Street Partners or Air Street Capital. He's out of London. The guy's my favorite, right?
Like your favorite. Or what is your favorite?
He's actually just You know, this was a Benjamin find. This is a guy out of Point Nine. I don't know if you know Point Nine. Great shop. And he's so responsive. He's on top of everything. His commentary is insane. He releases this, you know, 130 page slide deck of where AI is every year. You know, it gets picked up by Fortune.
Making you smart. He makes you smart.
Oh yeah, and then almost every, you know, it's funny because somebody pitched me an AI credit fund, right?
Yeah.
So I'm like, okay. And then my first question is like, Nathan, is this real AI or is this just some like basic algorithm? He's like, oh, this is just basic machine learning, you know? And he's like, gave me all the questions to ask. Makes me smarter, responsive on everything. I feel like highly communicative and honest with his company. It's like, yeah, you know, I think he's so brilliant on it. So that would be on like the super good bucket. There's kind of this bucket where I'm like, I think they're allocating, but they haven't really communicated. That's my less preferred bucket. And you know, there's definitely a bucket I've in private equity I've allocated before to somebody who just doesn't find a deal, right? And so that's okay too, but you just have to communicate that, right? So the worst is don't do a deal and don't communicate. The best is find great deals and communicate. And then like there's kind of the middle chasm of little communication and I don't know what your deals are. Like I just don't know. So talk up your companies, use your LPs. Again, like the way we thought about RPG was that our clients could help us at every point, proven to be. If you think about your LPs as a really helpful, you know, kind of helpful thought leader team, then do that too, right? Like create, you know, everybody's now talking about their LPs and their investments as a niche community that they curate, right? You keep hearing that. And then there's some truth to that, and it's kind of makes the LPs feel fun and it makes them feel engaged. And the more they're engaged, the more they're going to think about, you know, referring their friends to portfolio companies, or they're going to try to think like, try to think through deals for you, which I think is what you want in the end, right? Like you want to always be top of mind, and it's managing. You want to be top of mind to your companies, and you want to be top of mind to your LPs.
So last question, moving forward, now you have 45, I don't know, is that, by the way, it wasn't clear. Is that 45 funds or 45 managers?
So that's a good question, right? So I'd count like your friend John and my friend John. We have 3 funds. So we are one manager, 3 funds. Yeah, we've allocated them 3 times.
That's a little bit more manageable. Like, what are you looking for now?
Well, so, you know, we've had a couple calls with a couple managers this week. I think that we remain very interested in carbon sequestration ideas, kind of ESG. I think on ESG, when you look, maybe a lot of it's, you know, direct to consumer type plays. That's interesting. I think that the bigger problem in kind of ESG is really going to come in the really, really big stuff. So maybe there's a way just to ignite the really, really big stuff, right? So I would always look at green cement, right? Like a lot of people don't realize the CO2 emissions on just concrete and cement through the roof. So you know, I think there should be an interest on that, right? I don't know. That's kind of where I am.
That's awesome. So everyone, you know, if you know any good carbon sequestration, I can't even say it, sequestration funds, you know, reach out to Ryan. Hey, thank you so much for taking the time to chat with the Raise community and, you know, help our the folks that we work with do a better job for you. So
honored to help, Ben. Thank you. Thank you always for your friendship. Thank you.
Have a great day.